Most Aussies would retire broke. While you're scrolling through TikTok worrying about whether you can afford your $7 coffee this morning, your future 67-year-old is quietly panicking about surviving the pension payments or barely making the rent cover in 2050. But here's the kicker. If you are under 50 and watching this right now in 2025, you still have time. You still have time to completely flip the script. I'm going to show you exactly how 2 investment properties, just 2, can set you up to retire absolutely filthy rich. No crypto gambling, no get-rich-quick schemes, proper Australian real estate way, done it right in today's market. Hi, I'm Oxen Reza, and on this channel, we'll talk about real numbers, real strategies, real outcomes with everyday Australians who want to build serious wealth. I've built wealth from $30,000 in 2004 to amassing $18 million in property portfolio. And this is not a get-rich-quick scheme. I wasn't able to do this overnight. It took me years and years of constant work and understanding how the real estate market works for me to get to where we want to get. And today we are going to break some of those things together. Let's start with some hard truths about retirement in Australia that would make your skin crawl. Now, the full aged pension in 2025, including all supplements, is $29,874 per year for singles and roughly about $45,000 for couples. That's roughly about $575 per week for singles, barely enough to cover rents in most Australian cities, let alone living comfortably. The cost today of probably be about $180 to $200 in 12 years with 5% inflation. Now, if your income is fixed, all of this becomes worth less and less as the time goes on. And the bottom line, if you still want to retire with real financial freedom, the kind where you choose to, spend the time with your family, worrying less about money, you need assets that grow and generates income. And that's where property kicks in. Now, I saw a comment coming and asking about Australian property growth rates. With current market conditions in 2025, you're seeing more realistic growth patterns coming through. Based on the recent data, Australian properties are averaging about 3.5% annual growth, with annual yield sitting at about 3.5% nationally. But we all know Australia has 15,373 suburbs, and each suburb is a real estate market on its own. You would see markets that are growing at 6 or 7 or even 20 or 30% growth annually. And then there are markets which only grow by 1 to 2%. And all of this averages it out across the years. Now, we are talking about the yields is the same way. You're talking about regional areas that are still achieving yields at around 4 to 5%, but then there are pockets which would attract 6 to 7% yields as well, with the growth attached to it. But for the sake of today's story, let's be conservative and work with these real numbers. So here is why 2 properties specifically make sense in 2025 market. First, diversification. You're not putting all your eggs in one basket. You're spreading them around into various different markets within Australia for you to get the best out of both worlds. Second, it's actually achievable for most working Australians to save for 2 deposits over 2 to 5 years. Now, it might not be possible, but if you stagger the 2 properties one after another, the first property could provide for the deposit for the second property as well. With the current way the markets are growing and where the current dwelling prices are sitting at $1 million nationally, it's quite easy and convenient for people to stagger 2 properties one after another for the first property to provide for the deposit for the second property. Third, it's manageable from a cash flow perspective as well, without being, super rich or cash poor. If you have a family of 2 or 3, you can safely save for 2 deposits and support those 2 properties as investment properties while having your own principal place of residence. Let's look at an example. Let's say that you buy 2 properties worth $600,000 each in growth areas. Now, with 10% deposit with each one of them, you're looking at 2 properties and an out-of-pocket of $120,000. You add stamps and extra cost to it. Let's call it $150,000. That's still achievable if you're earning decent money and even living within your means. Now, even at 3.5% annual growth, these 2 properties comes close to about $3.2 million after 30 years. That's a massive return on your investment of $150,000. But here is what everyone forgets. It's not just benefiting from the capital growth. You're also getting rental income that should increase over time, helping you offset your costs and potentially turning positive geared as rents go up and you pay down your mortgage, or the interest rate comes down and you're paying it more faster. Now let's get into the cost that property spookers conveniently forget to mention. This is where we separate the dreamers from the realists. First up, property management fees. Property management fees can typically range from 5% to 10% of rental income, with most areas averaging around 7 to 8%. On a $450,000 property, renting for $400 per week, that's about $1,500 to $1,600 per year in management fees alone. Second is council rates. Homeowners generally pay between $1,800 to $2,000 annually for council rates, with properties in urban areas often attracting higher rates. So budget around $2,000 to $2,500 per year per property. Then you have got maintenance and repairs. Industry rule of thumb is 1 to 2% of property value annually. So again, on a $450,000 property, you're looking at $4,000 to $5,000. Don't forget the landlord insurance. That runs at about $400 to $800 per year in property, depending on coverage. Now, with insurance costs going up, it could also average up to $1,500. With some of these regional areas, insurance could be as high as $3,000 to $4,000 per year. So you need to be really, really careful of where you're buying that property and assume the right insurance cost. Now, here is the big thing that everyone ignores: the capital gains tax. When you sell this, if you own the asset for longer than 12 months, you pay 50% of the capital gains at your marginal tax rate. So if you're earning good money and you're part of the 37% tax bracket, you would pay 18.5% taxes on your capital gains. On a $2 million, that's $370,000 to the taxman. And suddenly the $3.9 million doesn't look quite as shiny, does it? But here is where the smart investors separate themselves from the wannabes. You don't sell the bloody properties. You refinance them, you access the equity, and you use that equity to buy more properties. Let's say after 20 years, you have 2 properties worth $2.5 million combined, and you've paid down the mortgage with a total debt of about $400,000. That gives you roughly about $2.1 million in equity. Most banks would lend you 80% of the property value, so you could potentially access about $1.6 million in equity through refinancing without selling a single brick. This is how wealthy people think about assets. They don't sell, they don't pay taxes, they borrow against depreciating assets and let other people's rent cover the interest. If you've heard Robert Kiyosaki talk about the money management side of things is basically debt, and it's smart ways of using debt to create more income. And this is what we're talking about today. This is where property selection becomes really, really crucial. You need properties that are going to generate strong rental yields in decent growth areas. Now, what about interest rates? I hear people ask and panic about all the time. Fair point. With interest rates around 6.5% today, potentially going higher, cash flow is tighter. And here's the reality check. On $400,000 loan at 90% of $450,000, you're paying roughly between $2,000 to $2,500 per month in repayments at current rates. That's $1,733 per month. You're negatively geared by about $370 per month before other costs kicks in. Add your $8,000 to $12,000 of annual cost, and you're out of pocket by roughly between $15,000 to $16,000 per year per property. On 2 properties, that's roughly about $30,000 to $35,000 annually. This sounds really, really scary for average Australians, but here is why it's not. First, it's tax deductible. So if you're on 32.5% tax bracket, that negative gearing saves you about $11,000 on taxes. You're really out of pocket, more like about $23,000 per year. Second, rent increases over time. That's $400 rent per week might get to $450 in 3 years or $500 in 6 years. Meanwhile, your mortgage repayments are actually coming down as you start paying off your mortgages. Third, you're building equity through mortgage repayments each month. So it's about $600 to $700 of your repayment goes towards principal, building your wealth consistently in the background. The key is having enough income comfortably to afford during the negative gearing period, or at least for the first 2 to 3 years. Now, if you're earning between $150,000 to $200,000 as a couple, $23,000 is quite manageable. It's like having a car loan at $400 per week, except it's not a loan, it's an asset that is going to appreciate. Start with one property, get comfortable with the process, build some equity, then add the second property when the financial position improves. You're talking about $200 per week that you can put into a separate account that you can use towards investing into property and build wealth slowly and gradually. The critical part is to start. Every year you wait is a year of potential growth that you're missing. Here is what I know after seeing thousands of investors over a number of years. The people who start early and stick to the plan, have the discipline in place, end up financially independent. People who wait for the perfect time or the perfect opportunity and worry about every possible risk end up working till 67 and live on pension. Your 67-year-old self is counting on you making the decision today. So please don't let them down. Now, if you found this content helpful, smash the like button, hit the subscribe for no fluff property investment content, or drop in the comments below if you are ready to start building your property portfolio, or share your story about what's holding you back. If you want to reach out to us, you can reach out to us at investorpartner.com.au or drop us an email at info@helpmebuy.com.au. I've got heaps more content coming in on property selection, financing strategies, building a property portfolio that actually works in today's market. Until next time, take care, keep smiling, be kind, keep investing. This is Moss checking out. Adios.